Hello investors, Sam Hack here with Rent to Retirement. I am in Denver, Colorado, one of the hottest real estate markets in the United States right now. But what makes Denver so hot anyway? And what makes a market worth investing in the first place? That's what we'll be discussing today, how to evaluate real estate markets, and we'll even give you a few of our top market picks. Let's first define what a real estate market is. The market is such a broad term. It can be applied generally or specifically, from as large as the global real estate market to as small as a certain neighborhood. For this video, let's assume a market is a particular metro area in the United States. The reason we want to analyze markets is so we can understand the risks and returns of investing in such a place. It helps clarify which market is going to be the highest and best use of our capital. To give us a proper market analysis, we're going to look at macro factors first and then zoom in on micro factors. Our first macro factor is a diverse and growing job market. The reason we want a growing and diverse job market is pretty self-evident. Population growth is usually in the form of employees, and employees need housing. Having new companies or growing existing companies creates more demand for housing, more young people moving to the area, increased occupancy rates, and therefore rising rents. Diversity in the job market is also important because if one large company or industry leaves that effectively employs the entire area, the local economy could be decimated overnight, resulting in a decrease in rental rates and home values. Think about Detroit when they were heavily impacted from many automakers relocating their manufacturing overseas. Macro factor number 2, tourism. Short-term rentals are becoming immensely popular, with some investors now making this their primary investment strategy. Tourism not only brings in people to visit attractions like national parks, entertainment, conferences, and more, but it also brings with it workers to support the tourism industry. The more tourists come into an area, the better short-term rentals and long-term rentals for workers will perform. Macro factor number 3, the price-to-rent ratio. The price-to-rent ratio is used for determining if it is cheaper to rent or buy a home in a certain market. To figure out the price-to-rent ratio, take the median home price and divide it by the median annual rent. A high price-to-rent ratio, above 21, means that there will likely be more renters than homeowners. For example, if the median price of a home is $1 million and you could rent it for $10,000 a year, you'd have a price-to-rent ratio of 100. And yes, everyone would be renting a home at this point because it would just make so much sense. A low price-to-rent ratio, 15 and below, means more residents can afford to buy a home and there will be less demand for rental properties. An example would be if the median home price was $150,000 and you could rent that home for $10,000 a year. The price-to-rent ratio would be a 15 and would make more sense to buy a home, which would decrease the demand for rental units. Don't forget median household income, which affects the ability for local residents to rent and buy. Use 30% of median household income to estimate yearly housing affordability for the average local resident. Macro factor number 4, property taxes and landlord-tenant laws. Take property taxes into consideration when looking into markets, as extremely high property taxes can turn a good deal into a bad one by taking away from cash flow. You'll also want to take into consideration landlord-tenant laws and find out just how difficult it would be to evict a tenant if it came to that. This has especially been emphasized in the past year as the federal eviction moratorium has shown favorable landlord-tenant laws can be the difference between keeping your property afloat or not. Adequate cash reserves can help hedge against these risks. Now let's talk about our micro factors. Although a city or metro area may check all the macro boxes, it's important to consider smaller chunks of the city as well. For example, just because Kansas City or Cleveland are great rental markets in a general sense, doesn't mean every single block of the cities are. The best neighborhoods for rental investments are clean, safe, close to public transit, have good schools, and other amenities. A few indicators of whether a neighborhood is a winner or loser are crime rates, listing prices relative to the rest of the city, school ranking, and retail types and prices. Is there high-end restaurants, or is there fast food? Is there an Armani or a 7-Eleven? Another good litmus test of a neighborhood is simply asking a large sample size of metro area residents what they think about the neighborhood and if they would live there themselves. The answers should speak for themselves. As Robert Kiyosaki says, the problem with real estate is that it's local. You have to understand the local market. So now that we have all these methods of evaluating markets on the macro and micro levels, it's time to go out and spend a ton of time compiling research and metrics, right? Well, if that's your jam, sure, but here at Rent to Retirement, we've done all of that hard work for you already. You can check out any of our favorite markets and why we chose them in this video playlist here. If you like this video, be sure to give it a like below and subscribe to our channel. If you want to find out more about what we do here at Rent to Retirement, check out our website at renttoretirement.com or set up a free call with one of our investment counselors in the description below. Also, give us a follow on any of our social media accounts or my personal page at Sam H Real Estate. Thanks for watching, and I'll see you next week.